These are 7 investing concepts that will make you money in the OnlyFans niche. Starting with number 1, lifetime gross profit compared to the cost to acquire a subscriber. This means how much money you make in profit from every person who subscribes to your content compared to how much it costs to get them to subscribe in the first place. This is the fundamental economic unit of the business. You buy attention, you buy eyeballs to get subscribers, and then you sell those eyeballs content that you're going to make a profit from. All the profit that gets generated from the business comes from this one ratio. For example, if someone has a 1-to-1 ratio of lifetime gross profit to the cost to acquire a customer, they spend $1 and they make $1 back. Let's say a 20-to-1 ratio means for every dollar they put in, they get 20 back as profit. This becomes a business that you can scale endlessly and becomes an incredibly attractive business. Getting really clear on what your lifetime gross profit to customer acquisition cost ratio is as core to growing anything. So let's define these terms. Lifetime gross profit has a couple of components. There's lifetime, and then there's the gross profit component. Lifetime is like, okay, how many times is someone going to pay me within a subscription business? How many times does someone renew on average over the lifespan? If you don't know this because you might be a smaller content creator that doesn't have advanced analytics, I'll give you the back of napkin way to actually calculate this. How many subscribers did you have at the beginning of the month? Of these people at the beginning, 30 days later, what's the number of those people that you have at the end? Not the number of new subscribers, but I want to know of the people at the beginning of the month, how many of them are still there 30 days later. So if you had 100 subscribers at the beginning and 90 at the end, then you would have a 10% churn rate. What we then do is we take 1 and divide by this number, which then means that our average lifespan in this example would be 10 months or 10 intervals, whatever interval you're measuring. Everything that I'm going to show you today is stuff that you can do with addition, subtraction, multiplication, or division. There's nothing else. You don't have to be a genius to learn how to invest or build a business. So now that we just covered lifetime, we need to figure out gross profit, which is how much extra cash we have left over from each subscriber after we do a transaction. The simplest example I can give you is if a subscription costs $10 a month and OnlyFans takes a $2 fee, then you have $8 of gross profit. Now, you still have to take that $8 and pay other costs like content creation expenses, marketing, and other fees. Now, remember, we figured out what our lifetime was, and we figured out how much we make per subscriber or how many months they stay. Now we combine those two metrics to get the lifetime gross profit. Earlier, we did the 10% churn example, and let's say that subscribers stay on average for 10 months. If you make $8 per month per subscriber, that means your lifetime gross profit per subscriber is $80. This is important because now this is all the money you have to go spend to acquire them and run the rest of the business. This is probably one of the biggest mistakes that content creators make. They look at their lifetime revenue per subscriber and think as long as it costs less than that in advertising, they're making money. But I'll give you an extreme example to point out why that doesn't work. Let's say you sell a subscription for $10 a month, but it costs $9 to produce content and manage the platform. If the average subscriber renews for 10 months, that's $100 in revenue but $90 in costs. If your team comes to you and says we're spending $50 to get a $100 sale, it might seem profitable, but really you're spending $50 to make $10 in gross profit over the lifetime. Not a good equation. The reason lifetime value and lifetime gross profit get conflated or confused is that many of the most formal businesses that are out there come from Silicon Valley, which almost exclusively is tech and software, and the gross profits on software are almost always close to 100%. The two can conflate, but for everyday content creators who have production costs, you have to calculate what your gross profit is because that's what you run your business off of. So far, we've got our $80 lifetime gross profit. Cool. We've got one part of this equation. Now let's talk about how much it costs to acquire a subscriber. This is another one that people mess up. What a lot of people do is just look at how much it costs them to advertise to figure out how much it costs to get a subscriber. That's partially true, but not completely because the advertising budget is only one of the many costs that go into acquiring a subscriber. You also need to include labor costs. Let's say you spend $1,000 a month on advertising and another $1,000 on content creation and management, making your total cost $2,000 a month. If you acquired 100 subscribers that month, your cost to acquire a subscriber would be $2,000 divided by 100, which is $20. If it costs you $20 to acquire a subscriber, and that subscriber makes you $80 in lifetime gross profit, you're doing great. That means you have a 4-to-1 lifetime gross profit to customer acquisition cost ratio. If you're wondering if that's good or bad, 4-to-1 is great. You want to make sure that you're always at least greater than 3-to-1, meaning your lifetime gross profit compared to how much it costs you to make that money is at least 3 times greater. Otherwise, you'll be too constrained to scale. If this ratio is bad, I don't need to look at anything else. I can just automatically toss the business out. If this is exceptional, I might overlook or forgive some other metrics that aren't as strong. If you don't know these numbers in a business that you're buying, investing in, or running, find them out. Number 4 is return on invested capital. What we're looking at is how much money it costs us to expand the business. Look at all the expenses you have in the business. This includes subscriber acquisition cost, OnlyFans fees, possible management fees, etc. Add all the expenses you have within a specific time period in your business and look at your monthly or weekly earnings, depending on how often you want to perform this calculation. Divide your earnings by the expenses you have in the time period you choose. I would love to see a 3-to-1, ideally a 5-to-1 return. So, if I spend $1, I get $5 back. Giving an OnlyFans management example, if I invest $4,000 into a model, I expect at least $12,000 to $20,000 in earnings next month. Anything lower than 3-to-1 just tells me that the money was not rightfully invested, and anything above 5-to-1 tells me that I made the right decision and I am going to continue whatever I am doing. If I fall anywhere between a 3-to-1 and 5-to-1 return, I will look at the trend of this investment. If it stays stable or even increases slightly, I am going to continue it. But if I see a negative trend, I am going to stop or decrease the amount I am investing into this model and invest it into models where I identify a higher return. Number 5 is the payback period. Simply put, how quickly are you paid back for getting a new subscriber? If you spend $20 to acquire a subscriber, how quickly do you get it back? If you had 2 scenarios, one where it takes you 3 months to get your $20 back versus another where you get $20 in the first month, you'd rather get the money sooner. The number of how long it takes to get paid back is a good indicator of how cash flow positive the business is. Some easy ways to shorten the payback period are to get subscribers to pay for a longer duration upfront, charge an onboarding or initiation fee, or offer upsells like exclusive content. For example, if you charge $10 per month but get them to pay for 3 months upfront, you get $30 right away. If you add an initiation fee of $10, you get $40 in the first transaction, covering your acquisition cost and providing positive cash flow sooner. Number 6 is sales velocity times lifetime gross profit, which means how many subscribers you are gaining per month times what these people are going to be worth to you over their lifetime. For example, if you gain 100 subscribers a month and your lifetime gross profit per subscriber is $80, then your revenue potential at scale is $8,000 a month. This metric helps you understand where the revenue of your business will be at scale. If someone comes to you and they're gaining 100 subscribers a month with these metrics, you know the business is on a growth trajectory. Number 7 is sales velocity divided by churn. If you have a churn rate of 10% per month and you're gaining 100 subscribers a month, your hypothetical max number of subscribers is 1,000. This tells you how many subscribers you will need to sustain the business at its peak. If you're currently managing 500 subscribers and you know you're going to reach 1,000, you can plan for scaling your operations to handle the increase. This gives you a good idea of where the business is headed and helps you make strategic decisions about resource allocation. When you take the first 7 metrics and plug them into this framework, you have a solid foundation for analyzing your OnlyFans business or potential investments. Track your numbers monthly to get a clear picture of your business health. If you're a successful content creator looking to expand, these concepts will help you grow strategically and profitably.